Have you ever wondered if it's possible to consistently beat the stock market? What if I told you there was a man, a former math professor, who not only beat the market, but utterly dominated it? Meet Jim Simons, the founder of Renaissance Technologies, the man behind the world's most successful hedge fund that consistently outperformed the stock market using math. Jim Simons wasn't your typical Wall Street executive. Before conquering the financial world, he was an accomplished mathematician. Born in 1938, Simons earned a PhD in mathematics from UC Berkeley at just 23 years old. He quickly became known for his groundbreaking work in geometry and topology, fields that, at the time, had little obvious connection to finance. But it was Simons' time at the Institute for Defense Analyses, working as a cryptographer during the Cold War, where his fascination with patterns and data really began to take shape.
There was a place in Princeton called the Institute for Defense Analyses, which was a highly classified place under the aegis of the government, the Defense Department. And what we're supposed to do is break Russian codes. Well, that was an interesting challenge. I liked the work. They told us you could do your own mathematics up to half your time, but the other half you had to do, this code cracking business.
In 1982, after leaving academia, Simons founded Renaissance Technologies. Unlike traditional hedge funds, Renaissance wouldn't rely on market intuition or gut feeling. Instead, Simons brought a novel idea to the world of finance. He would use mathematics, data, and algorithms to make sense of the seemingly chaotic movements in the stock market. He gathered a team of the brightest mathematicians, statisticians, and scientists, creating what would become one of the most secretive and successful hedge funds in history. But how did they do it? Renaissance Technologies used quantitative analysis, a branch of mathematics that involves using statistical models and algorithms to make trading decisions. They analyzed massive amounts of data, looking for hidden patterns in the market that no human could detect. Simons and his team didn't care why a stock moved. They only cared that it moved in a way their data predicted. This approach allowed them to make trades based on probabilities, backed by mathematical certainty rather than market sentiment. So, what kind of math are we talking about here? Simons and his team used a technique called statistical arbitrage, essentially finding tiny inefficiencies in the market and exploiting them before anyone else noticed. This required analyzing massive data sets, from historical prices to economic trends, even weather patterns, using machine learning and artificial intelligence.
Really quite wild, quite unexpected. I mean, you look at everything, right? You look at weather, length of dresses, political opinion.
Length of dresses we didn't try, but...
what sort of things?
Well, everything. I mean, everything is grist for the mill, except hem lengths, I have to say. Weather, annual reports, monthly, quarterly reports, the historic data itself, volumes, you name it, whatever there is. We take in terabytes of data a day and store it away and massage it and get it ready for analysis. And you're looking for anomalies. You're looking for, like you said, the efficient market hypothesis.
But
right.
Any one anomaly might be just a random thing. So is the secret here to just look at multiple strange anomalies and see when they align?
Well, any one anomaly might be a random thing. However, if you have enough data, you can tell that it's not. So you can see an anomaly.
They also employed methods from signal processing, the same kind of mathematics used in radar and cryptography. This allowed them to sift through market noise and extract valuable signals that pointed to profitable trades. The real genius lay in their model's ability to adapt. Financial markets are constantly evolving, and Renaissance's models could learn from the data, automatically adjusting their strategies based on new information. The flagship of Renaissance technologies is the Medallion Fund. This is where Simon's math-driven strategies truly shined. While the broader market fluctuated wildly, the Medallion Fund posted returns that most investors could only dream of. From 1988 to 2018, the Medallion Fund averaged a jaw-dropping 66% annual return before fees. Even after the hefty management fees, investors were seeing returns around 40% per year. To put that in perspective, most hedge funds aim for just a fraction of that, and the S&P 500, a typical stock market index, averages about 10% annually. These numbers are unheard of in the world of investing. But there's a catch. Medallion is so successful that it's closed to outside investors. The only people who can invest in it now are Simons and his employees. Despite their staggering success, Simons and Renaissance weren't without their challenges. The market isn't always predictable. There have been crashes, unexpected events, and global recessions. Yet, Renaissance technologies seem to navigate these waters with remarkable resilience. However, Renaissance has faced criticism. Some argue that high-frequency trading firms, like Renaissance, contribute to market volatility. Their reliance on algorithms and speed mean they can execute millions of trades in milliseconds, potentially distorting markets.
I'll now turn briefly to the questions that the committee asked. Do hedge funds cause systemic risk? Well, in my view, hedge funds were not a major contributor to the recent crisis. And generally, hedge funds have increased liquidity and reduced volatility in the markets. Moreover, because of their remarkably diverse strategies, hedge funds as a class are unlikely to create systemic risk, although it's not out of the question that they could.
In 2010, Jim Simons stepped down from daily operations at Renaissance, but his legacy continues. Today, he's as well known for his philanthropy as he is for his financial genius. Simons has donated billions to scientific research, education, and autism studies through his charitable foundation.
That's what we've done. And 6 years ago or so, I left Renaissance and went to work at the foundation. So that's what we do.
And so Math for America here is basically investing in math teachers around the country, giving them some extra income and giving them support and coaching and really trying to make that more effective and make that a calling to which teachers can aspire.
Yeah.
Jim Simons is living proof that math isn't just for the classroom. It can be a tool to reshape industries, build fortunes, and even give back to society. While Renaissance Technologies remains a mystery to many, its impact on the financial world is undeniable. Simons didn't just beat the market, he redefined what was possible using nothing more than numbers, equations, and an unrelenting drive to find the patterns others missed. So, the next time someone tells you that math isn't important, remember Jim Simons. the man who beat the stock market and did it with math.